If you look at gold prices today, it got smacked down big time. It's 1187 right now, 8 p.m. Central Time. And what I said previously, I think a few weeks ago, saying that, you know what, I'm starting to get bullish on gold and silver. Maybe towards the end of the month, I may want to pick up some bullion, which I haven't done for the most part this year. I've only bought 10 ounces of Eagles. I maybe have bought some junk silver. I don't remember when, but for the past 14 months, I've only bought 10 ounces of Eagles and then some miners here and there. And it was really hard, first of all, not to buy gold and silver, especially me being a stacker. In addition to that, I felt that there would be probably a repeat of what happened in the 1970s. This was going on in my mind, where you saw gold. I could show you right now what happened in the 1970s. Okay, this is the book Commodities for Every Portfolio. How you can profit from the long-term, I don't know, I think it's the bull market of gold and silver. I have to look at that title. I could get to that later on. But I found this interesting paragraph that I read a while back, and this is something to note. A golden example. During the first stage of the 1970s gold bull market, the price of gold moved from $40 an ounce to $199 an ounce. The move up, however, did not happen overnight. It took about a couple of years for the price of gold to finally close at just below the $200 ounce level. In 1975, the price of gold suddenly sold off sharply, falling to just below $110 an ounce. While this decline was substantial, especially in the moment, it ultimately just represented a correction in a substantial multi-year bull market. So it's talking about how gold went from $40 to $200 an ounce, and then it had, I believe, a 43% retracement. So if you do the math, it's roughly a 44-45% correction in the price of gold. Now let's look at a 3-year chart of gold, and if you look at what happened in 2011, you saw pretty much double or triple tops of gold. I thought it hit 1923 times, but chart's showing 2 times. So it was like 1900, 1920. So if you want to do the math, if you want to see what happened in 2011 and compare it to what happened in the 1970s, let's just take our calculator out. So if the price of gold went from $40 an ounce to $200 an ounce, or $199, and then dropped to under $10 an ounce, let's do the math. So 199 minus 110, okay? And you divide this by $200 an ounce, or $200. That's 0.445. Okay, so that's a 44% correction in the price of gold. Now, take this spot price of gold at the high, 1920. Okay, so you take 854 and minus 1920. Okay, so it's going to be roughly around 1065. So basically, if you see a repeat of what happened in the 1970s, where you saw a 44-45% correction in the price of gold, then this thing should go to roughly, I don't know, 1070 an ounce, 1065 an ounce. That's something really interesting to note, because there are some CMT guys, such as Jordan Roy Bryn, who actually has his subscriber portfolio list, or his stock list. I mean, he's been doing pretty well according to what it's shown on his website, assuming that he's not lying about that. And if you look at it, what he's been saying, that you could see potentially one more correction, and then you're probably going to see this bull market go up. I'm going to try to get him on here probably after the new year, or maybe late next week, and we could discuss this. But if you see something like what happened in 1970s and compared to now, and the same metrics apply, who knows? This thing could go to 1065. Once again, this is not a buy or sell recommendation. This is just what's going on in my mind right now. And once again, if you're new to this market, always talk to a financial advisor, or B, do your own due diligence, because markets work in irrational fashions. And those are my thoughts, guys. Leave your thoughts below, and I'll talk to you another time.